today, Tesla's pissing off the world, Trump's pissing off the world, and the tech sector is about to release earnings, and all of this is affecting my $110,000 dividend portfolio, currently dripping $4,848. So let's jump right into this. Welcome back, my passive income investors alike. Today, before we head over to the computer and look at my actual Scotia iTrade account where I contain all of these beautiful holdings, I just want to analyze some of the news really quickly for you guys, what you YouTubers are talking about. We're going to start with Tesla. Tesla's been continually pissing off the YouTubers.
But this makes me a little upset, okay? Grr, Elon Musk, okay? Because I just bought one about a month and a half ago, okay? And basically, I paid an additional $5,000 versus what I could have bought it for today.
Now, this is just because they're lowering prices on their cars, which is something that I absolutely love, because I've been dying to get a Tesla, but I keep telling people just wait, because the prices keep coming down, cars keep getting better. Give it another 2 years, let things kind of settle out, let the cars become really priced in. A lot of people have been buying cars, and then 4 months later, Tesla's been dropping the price by like $5,000. As a shareholder, I love hearing this because it's going to help expand the company, but if you're buying the car, you're continually getting pissed off because every 6 months to a year, the prices keep coming down. Now, honestly, the way I look at it is I want one. I've been dying to get a Tesla. The payments make sense. My car I bought for $11,000 outright, cost me $500 to $600 a month. That's gas, oil changes, repairs, insurance, everything included. At the end of every year when I run my books, I find my car always costing me between $500 and $600 a month. With the same $10,000 down payment on a Tesla, the payments are right around $400 to $500 a month, which is pretty much the same as what I'm paying anyways, but now I'm not going to gas stations or getting oil changes. So I think it would be a neat little buy, but I'm not there yet. I'll probably give it another couple years at the most before I start looking into actually purchasing one of those cars until I drive the current car I have into the ground. But that's been a lot of the cool news going on with Tesla, and I'm surprised that it should be driving the stock higher, I would think. But anyways, guys, we're also going to talk about GEO Group. Getting locked up in jail, baby. Locked up in jail, baby. There's a lot of those guys. Actually, one of the imprisoners as one of the El Chapo, that little Mexican drug lord is finally in jail, hopefully here in the U.S., so we can make some money off him going to jail as well. They've been having a hard time keeping him in prison in Mexico, so now he's here, which is good for us if you're a prison over a core civic GO group. There's only 3 prison stocks in all of the U.S. that I think actually exist. Now, the big problem with GEO Group is as I've been buying it, it has been plummeting. It's down about 20+% right now in my portfolio, which we'll see in a sec. But the reason it's down is because political uprunners have been thinking they can uproot the entire private prison sector, and they think they can just abolish it, which I think is hilarious because their plan doesn't really involve any way of demolishing a private prison sector. Actually, what their plans state is they just want to more or less regulate how commissaries are delivered amongst prisoners. Because right now, if you're a serial killer in prison, you just murdered a bunch of people. Why should you have the right to a phone? So what these prisoners do is they charge these serial killers and these screwed up people $100, $200 to use a phone, just for a phone call. And then me and you that own the company are actually profiting off this. And these uprunners don't really like that. So they kind of want to start getting rid of the privatized prisons. But what they don't realize is the infrastructure is managing hundreds of thousands of prisoners. And people like me invest into it to help them deal with that infrastructure. So I technically own a piece of the real estate. You can't just rip that out from under me. And now Trump is even firing back at these people, saying, go back to where you came from, because apparently a lot of them weren't born in the U.S. He says, go back there, fix the problems in your own country, then come here and try and tell me how to do it. So I thought it was kind of funny that he's actually starting to chime in on these people that are saying he's doing a horrible job with managing the Mexico border problem, paying all these prisons all this money so people like me make money. I don't think this company's going anywhere, but we're going to analyze it when we head over to the portfolio. But finally, the last thing I want to say, guys, is that you really want to pay attention to the tech sector this week. We have Microsoft, Apple. A lot of the big companies are coming back into earnings season, and this is super, super important. These earnings are going to decide whether the stock market's going to continue into new highs or whether we're going to see problems, because the tech sector has the majority control over where the S&P index goes. But lately it's been McDonald's and kind of the non-cyclical stocks. I don't know why they've been driving up so high. I think it's because there was so much fear in the markets. Usually when there's fear, people go to those stocks they know do well in depressed times or recessions. But honestly, guys, I think this tech sector earnings is going to be a really big highlight for the year, and we're going to get to see where the stock market's going to head. I hope Apple does great because I want to see it get over $210 so I can sell it and start rebalancing my entire portfolio. So let's, in light of that, head over, guys. Plus, I want to say it's been a big bonus today. I realized I'm over $400 a month in dividends now. I don't look at it that way, and I'll explain why I don't look at it that way, but that's the reality of it. But we'll head over to the computer and I'll explain more. So come on, guys. Come on. Let's go. All right, here we are in the portfolio, guys. We're going to take a look starting at the very top of the TFSA. We have 3 accounts we're going to look over, including the RSP that I just opened. But first of all, we're going to start with the tax-free savings account. We have some dividends that are incoming. We're going to be getting a lot by the end of this month, but we finally got 21 in US dollars and about 15 CAD. I think I had $20 in here already, give or take, but it was right around $60, $70 in dividends. Plus, we're going to be getting quite a few more. I think the equivalent amount by the end of this month will be between 500 and 700, give or take. But let's take a look at the positions. The Canadian Imperial Bank, Canadian banks continue to lead lower. Canadian Imperial Bank was just downgraded to $1.20. I love the way their downgrades take them up way higher than even where they sit today. But just taking a quick look to analyze this, guys, we can see no one likes this bank. They came out with earnings, I think, in May. But I think this is just a continuation of how the banks do their cycles, guys. They kind of, do these long, flat runs for a few years and then have some run-ups. As soon as this thing starts running up even a little bit, if I get closer to like an 8 to 5% loss, I'll consider selling some of this. I'll do the same with the Bank of Nova Scotia, but because I'm not as down as much on this, I'm just being patient with these. I'm not in a rush to sell them, but I'm going to start leveraging them into other stocks, as I've mentioned. But unluckily, this one keeps continuing down further and further, being one of my biggest, worst positions. Again, with Bank of Nova Scotia, it's kind of crazy to think the banks are the worst positions, but again, we're still talking. It's only been a small handful of years here, guys. We're not anywhere near into a long-term investment portfolio. This is only 5 years deep, and a lot of these positions are pretty new still. The positions that have been in this portfolio for a long time, you can tell that they've been here for a while because they're doing really well. Northland Power has been here since the beginning. I've been buying it on and off consistently. Apple's been here since the beginning. It's been one of the earlier day stocks, and we can see it's been doing really well. And even with me managing money around, I still got a really good buy price on this. But as these come out with earnings this season, guys, it's going to be very important to keep an eye on these stocks because they're really going to debate the future of where this next little these lines are going for the S&P 500 index. But we're just taking a look here, guys. I'm glad I got British American Tobacco in here, and I'm glad I bought it when the Canadian dollar was up, because we can see I overpaid for this by almost a full $1.50. And even though I paid for it for over $1.50, I'm actually not down hardly anything, and that's because the Canadian dollar has come down a lot, which means the US dollar goes up, which means when I bought this, I was getting more for my purchase value. And that's why I try not to purchase really small chunks of stocks either. Usually I like taking advantage of opportunities and purchasing 3 to 4. I try not to, in the smaller scale of things, if I'm doing little dividend investments, it'd be like 500 to 1,000, but I try not to dump any more if I'm doing a full position grab. Somewhere between 2,000 and 3,000 is the minimum, because then you get to take advantage of the dollar fluctuations and everything else, which in times like this we can see really helps out. When we head over to the other portfolio, I also have more British American Tobacco there, but I think I purchased it when the dollar was down. So I'll show you how the dollar really affects your positions. GEO Group is one I was just talking about. Before we head over there, though, I'm just going to admire the fact that I think British American Tobacco and the tobacco stocks right now are still an incredible buy, and I'm going to continue adding them to positions. But speaking of my prison stock, here we are. Oh, we're just under 20% today by the looks of it, but we're hitting about a 20% low. And I was buying this stock because of all the good news going on back here, guys. When this stock started taking dips back here and they just started fluctuating around, I realized that Trump was going on about, the fact that they're giving them a $100 million pay bump and all this stuff. So I started buying into it, and then we saw it rally right up almost back to 25. I was buying it in the 23, 24 range. And then all of a sudden the bad news came out that the political uprunners want to take this company down. So here's a company that's been making more money than they've ever made in their entire careers, yet the stock is doing the exact opposite. It's down quite from its all-time highs of, 32-ish, and we're all the way down to 20 or 18. So the discount here is massive in my opinion, and I'm buying it knowing the volatility is going to be insane. I just know they can afford this dividend, and I think it's going to be reliable so long as we get through the presidential BS that we're going to be hearing about. So don't expect much out of this stock price-wise, I think, for the next year or two. I honestly think with all the news, all the craziness going on, that this stock is probably going to run flat or have a lot of volatility in the next couple of years, just until the presidential campaigns get out of the way. But moving into the tech sector again, guys, here we got Microsoft, one of my other best performers, outperforming Apple substantially. Again, this is in US dollars, so this would be around 2,600 to 3,000. SO is another one of my favorite utilities, continuing to do well. I want to buy more of this, and now that the price is kind of coming back, not as much as I'd like to see it come back, I really want to buy more of this, but I'm waiting for a good dip. When this thing dips down, I'll consider relaunching some capital into this company because I don't have enough of it. When I bought my $4,500 worth of shares, I plan on buying more, and then the company just kept going up. And now I'm stuck in a situation where I have a company I love, but I can't get over my average buy price, and I'm terrified to buy more because I don't want to over drag that up. So moving into the other account. And don't worry, we're going to go over the dividends as well. Here's the other tranche of British American Tobacco I started buying, and as we can see, I bought it at $33.98, so 34. So we're up $2 a share. So you think being up $2 a share times 162 shares would be over $300 profit, but I'm only up $99.67 in profit, and that's because the Canadian dollar has come down. And I purchased it when the dollar was cheaper than it is right now. So technically I bought it when the dollar was up, and that leads us into this weird position where looks like I should be up more than I am. But the combination of both, this is my full position in British American Tobacco. I'm going to continue to migrate these stocks over to my TFSA. But we can see, guys, MO hasn't been doing that well because I was buying it roughly at the same time. So even though I'm up on the dollar value, I'm not up overall because of the exchange rate. And not that that bothers me. We can see Tesla's coming back. Anybody that bought that dip was doing amazing. Today, I figured it'd be good news, considering, they're lowering prices of their cars. You think the stock's been doing really well. Anybody that caught that 170 mark in that dip, I remember making a video. You can go back to when I talked about Tesla, like not even a few weeks ago, and I said, anyone buying this dip, I don't think you're going to do wrong. I just don't have enough money to be buying those kind of dips to make a difference, because I'd only be buying like 2 or 3 shares. So whoop-de-doo, if I'd be up maybe 50 or $100 on 2 or 3 shares, it really wouldn't affect this overall position as much as you think. It sounds like a lot, but we're talking 5-10 year term here, guys. 10 years out, I honestly don't think you're even going to remember what's going on today. So to have these shares anywhere between, I'm going to say between $100 and $400, I think is fairly reasonable. But that's up to your personal perspective. And we can see the stock's up $4 today, probably on the news of them lowering their car prices. So, I mean, I still think it's a good buying opportunity around here. If I get the chance, I will buy more, but because I'm more focused on dividends, which we'll get into a second, I don't want to be buying more stocks that don't pay dividends. But here we got BMO, guys, my other bank. One of my only other banks is doing really well, helping mitigate some of the losses I'm having with some of those other banks. Whether I continue to hold BMO will be debatable. I think I'm over leveraged in banks, but I'm not too worried about it for now. I'm just going to keep an eye out on them and find a good selling price, not full sellout, just to sell out a few $1,000s worth in each one, just to continue to diversify the portfolio. So here's my first Vanguard index purchase. This account I've had a lot of debates with, but the reason I have this account is because I want to use it to purchase real estate tax-free. Every dime I put in here, I don't have to pay taxes on. $4,000 put in here, saving me $800 in taxes so far this year, and I'll be able to draw this back out to purchase a home in the next 2 to 3 years. So I'm going to put it in very safe index funds like VFVs, so the fluctuations aren't too large. For that, guys, I'm not going to lose too much because I'm holding really safe ETFs. So if I had to sell this tomorrow, I'm only going to be losing like 30 or 40 bucks. I don't know if it's going to load or not. I've been having some issues with this RSP loading up the positions. But the Vanguard 500 Index ETF, this version of VFV is the Vanguard Index in Canadian dollars, which I absolutely love because it stops me from converting money around, but I still get exposure to the S&P 500 Index. I wish this would open. I don't know why it's having so many issues. But yeah, I've got a little bit of money in this account. I'm going to continue funding it, but this is my future plan to buy real estate tax-free. So I'm using these accounts to take advantage of those opportunities. So don't get too caught up in the fact that I'm holding these positions. I do want to own this what's happening here? I would love to own these positions in my regular trading account, and I plan on purchasing them over time. But for right now, I'm just using them as a safe short time hold between 3 to 5 years at some point, at hopes of using it to purchase a house. So I'm not really contributing these dividends toward my income. It's what I was saying at the beginning of this video. As we take a look at dividends in this account, I'm making $68.61. Now, I can't use these dividends for anything. I can't pull them out. I can't touch them without being penalized. So I can't really use this income other than just to leave it here and progressively grow the account until I plan on using it to buy real estate. So, I mean, here it sits with an extra $68 versus income. But when we go and look at the other accounts, guys, I'm currently sitting right around that $4,800 mark. It's between $4,770 and $4,780 plus the $60 dividend from the RRSP. But if we look here, we got $1,208 in US. Not much has changed here because I haven't purchased any more stocks in my tax-free savings account yet, but I will be by the end of this month. With the dividends coming in, what I purchase, I'm not sure yet. I might purchase GEO Group while it's down here because it seems to be the cheapest. I will really want to keep buying BTI, and I need to get MO in this account at some point, and I plan on doing that by selling out of some of my Apple shares. But as we can see, Apple is one of my best paying companies along with Microsoft. I don't want to sell too many of these because I like the dividend yields I'm currently getting. I got in at a great price, and I think these dividends will increase over time, so they are part of my long-term holds. I just want to see this a little bit lower so I can start averaging up and just diversifying in a way where things are a little more balanced, because I am way over leveraged in Canadian Imperial Bank. Sure, the dividend is nice, but it's too much to rely on, because if I lost this dividend, it would really affect the overall income. So I want to continue diversifying it. As we can see down here is nice, and try and get it so no company is making me more than $600 a month, which is $50, or sorry, $600 a month, $600 a year, which is no more than $50 a month. And we can see the pay structure up here. August isn't looking too pretty in this account, September, but at least we're getting general payments every single month, which is what I like to see. And then in the final account, and by the way, this is my TFSA, so I don't pay taxes on any of this income. This is all tax-free, minus obviously the withholding tax that comes from the US, but I think that's automatically deducted already in these prices. Don't quote me on that, but the government in the US takes 15% of my US dividends, which isn't a lot. So for every $100, they're taking, what, 15 bucks? It's not terrible, but it is the way the world works. So that's why I try and own a 50-50 split of US versus Canadian. And here's the final account, guys, paying me $1,236. Now in this account, we can see there's not a whole lot going on. We're getting some nice payments in August from this one, none in September, good October. So from August, we're getting 200 from this account, and we're going to get another basically 200 from this account, because 112 US converted to Canadian is about 130 plus 50. It's about 182. Plus 200, that's pretty good. I'd say that's almost $400 in income. So August is looking pretty good for the two accounts. And then finally, guys, let's just take a peek at the performance, because we got some performance updates for last month. I don't show you guys this as often as I'd like. So the originally my other account, my regular account, which is this line right here, the cash account, this is the one I have to pay tax on that I'm trying to manage. That account was doing really well this year because BTI was on a run. I bought dips that just seemed to do really well, but lately they've all pulled back. Tesla's not doing well. So this account has a lot more volatility to it, whereas the blue line is my tax-free savings account that I don't have to pay any tax on, and has a lot more stability because I'm holding more of the S&P 500 index kind of stocks. So we can see it really follows the index, that blue line, which is the basic index, the S&P 500. It really sticks closely to following that line, whereas because the individual stocks I hold in my regular cash account are a lot more volatile. And we don't see the RRSP in here. I don't know if they allow me to do the RRSP in here. I don't see it on my list. Maybe it comes up in a little while because it's a new account. I don't know, but we can take a look at that a little bit later. It's too new to start analyzing the performance. But this is the track record from September of 2014, guys. So we are officially almost 5 years deep into this portfolio, and we can see that I went from shitty times to much better times, and I'm here to share it all with you. So if you enjoy this, guys, consider slapping a like and subscribing. You can learn from this. This is my way of showing you how I'm going to do my financial independence, retire early journey. So I'm glad you guys enjoyed this quick little bit. Stay cool. Stay awesome, guys. I look forward to chatting you real soon.